One of our viewers asked this question. I retired early with $300,000. Should I start investing now? So stay tuned for the full episode. Welcome back. This is Richard with Wisdom Investor. One of our viewers here wanted to know if this is a good time to start investing. So we're going to investigate this. By the way, if you have any input on this situation, leave your comments. They're much appreciated. Here's our question from our viewer. I retired early, sold my house, and moved to Mexico to save money. I have $300,000 saved. I'm currently investing in a higher rate savings account. I want my money to last a lifetime. Should I start investing in the stock market now? Okay, this is a great question. There's a lot to this question. A couple of things I took from this. Right now, he's invested in a higher rate savings account. So I'm taking this as the person is somewhat of a conservative investor at this time. And he wants to know if he should invest right now. Let's take a look at our current market situation. We're looking at the S&P 500 here. There's a weekly chart, goes back about a year here. And you can look at our current situation here. The markets have dropped as much as 10% on the S&P 500 the last few days here. We've had a bounce back. However, it doesn't tell the complete story. Here's a chart of the S&P 500 stocks above the 50-day moving average. You can see right now at the time of this video, about 42% of the stocks in the S&P 500 are above the 50-day moving average. For those investors not familiar with the 50-day moving average, we're looking at the S&P 500 on a daily chart that goes back to September all the way to February of 2022. You can see this red line here. This is the 50-day moving average. Here's a chart of Netflix. You can see the price is way below the 50-day moving average. Here's a look at Facebook. Many of you heard about Facebook this week dropping about 26%. And again, it's way below its 50-day moving average. Here's Procter & Gamble. Now the price of Procter & Gamble is above the 50-day moving average. And you can see it's still doing well. So not every stock is dropping. Here's a look at Coca-Cola. Again, this stock is above the 50-day moving average. So you can see why our investor here is concerned about the stock market. Should he invest now? You can see some of these stocks are dropping big time and other stocks are holding up. One of the things that may be causing the market to have a lot of volatility in it is because of the threat of the Fed of raising interest rates. Here's the federal funds rate, and we're way down here near zero. They have not raised rates yet, but their threat of raising rates is causing the market some indecision. And you can see eventually after the Fed does raise rates, we do get into some kind of recession here. These gray bars here are times of recession. Looking at a chart of 30-year fixed mortgage rates, you can see mortgage rates have risen. Even though the Fed has not raised rates, bond traders are selling bonds. Therefore, rates are increasing in the markets. Here's a look at the federal fund rates again. Again, we're near zero, but there's anticipation here that the federal funds rates are going higher. And if you look back here in 2003, 2005, you can see rates increased, and eventually that was followed with a recession. So far, the threat of a recession is still pretty low because the Fed hasn't increased those rates. However, if they do start increasing those rates, threat of an inverted yield curve could come about. The other thing that has investors concerned is the PE ratio right now at 22.4 times the market. This U.S. stock market is overvalued. So with the overvalued stock market, with stocks showing earnings less than expected and the threat of higher interest rates, you can see why a person would ask, is this a good time to be investing in the market? Here's an interesting chart to be aware of. The left-hand column is the date of the first rate hike, and then the next 3 months how the S&P 500 performed, and then the next 6 months how the S&P 500 performed, and then the next 12 months. What we can gather from this, typically there can be an initial reaction from an increase in rate. However, looking at past history, the markets continue to do better even though there is a rate hike. But then eventually the rate hikes go too high, go too far. They reach a threshold point where the economy starts to destabilize, and then we go into a recession. Now, one of the worst things a new retiree can do is go all in the markets at the highs, and then the markets proceed to the downside, and it can take years for your financial situation to recover. None of us know exactly what the markets are going to do in the future. However, looking at past history, we can kind of get an idea of how the market reacts under certain circumstances. So we have the possibility of interest rates being increased by the Fed. We have a high valuation for stocks, and we also have earnings reports coming out, which could be less than expected. So for our viewer here, I would recommend our viewer be patient here over the next couple of months. Let's see how the markets react after we get a rate increase, and then possibly start investing. We get a nice dip in the markets, then a person could lump sum invest in the markets. Otherwise, dollar cost averaging into the markets right now is the best way to go for the average investor. Now, for long-term investors, there's no reason to sell out in the markets right now. Continue dollar cost averaging. I would not do any lump sum investing right now. Also, every person needs to be aware of their own risk tolerance level. So I want to thank you for watching. Leave your comments on what you think our investors should do. Stay tuned for our next update.